If you look at the way they're trading versus the bond market, and I have a lot of several different ways of looking at this, going back all the way to the 70s, they're trading very expensive versus their historic relationship to the bond market. They have, in fact, since early June, the group of stocks that are the most bond proxy-like in my universe are actually up 14.5%. And the market's down about 4.5% over that period, despite the fact that interest rates are up demonstrably. And that's because they're pricing in, frankly, fears that we're going to go into a recession. In prior periods leading up to recessions in my model, they've traded very, very expensive to where they should have been versus interest rates at the time, because, frankly, the downside associated with being wrong on a utility stock, if the economy goes pear-shaped and the market collapses, pales in comparison to what you'd lose in the market. And so they're just seen as highly defensive securities, and they can trade very expensive relative to that traditional bond market relationship in those types of environments.
Give me two names that you like the best.
Well, I think if you're playing this rally in utilities and you want to, and you sort of buy into the thesis that you're buying portfolio insurance by owning them, you don't want to chase stocks that are already trading at very high valuations. My favorite is actually for that is First Energy. They actually reported a really solid quarter today, raised guidance for the year. The stock is actually selling off because people didn't get precisely what they wanted, in my view, on the pace of dividend growth. But this is a company actually trading at a 2P multiple discount to its peers that is about to raise the dividend, I think, in the first quarter, 6% for the first time in 5 years. That's got a very low risk transmission and distribution business, and probably should be trading, all things equal, given where the utility stocks are valued today, at least $40 a share. It's trading at under 37.
Give me one more name.
My second favorite would probably be PPL. PPL Corp is actually a bit more of a complex company. It's 50% of its business in the U.S., 50% in the U.K. It's extremely depressed on valuation because it concerns mainly over what's going on in their business in the UK and political and regulatory risk there. But it's got a dividend yield of over 5%, very low valuation, so you've got a lot of downside protection in PPL.
Hey, Greg, in terms of just market dynamics for utilities, my sense is a lot of this is even short covering, and that you got a nice pop on this turn in sentiment, certainly towards maybe slower growth in this bond proxy, but that's the best you're going to get right here.
You know, that may be part of it. I'm not going to dismiss that. The short interest in utilities hasn't been big, but if you look at the Evercore ISI research product, one of the things we do is we do surveys of all of our clients, and in fact, I think investors are almost invariably always underweight the group. So maybe they're not. It's not short covering. But generalist investors are usually underweight the group, and so there's performance chasing when they need to get more exposure. And I also think hedge funds were probably modestly net short and had to cover.